So Seth, we're gonna get right into it. We're gonna explore your background today a little bit because that's not in the agenda, but we want to get into that a little bit first, and then we'll go into the topics du jour for the day. But the first thing I wanted to share about you, because you're a really impressive person in my mind, right? I've known you a lot of years. I've seen you achieve a lot and grow a lot in your career. The most impressive thing I've seen is your silent partner speed chess game, because it's a very impressive knowledge base that you bring to that. And Colin has been dealing with my amateur chess skills in our office. We have a little chess table and we take turns going back and forth, and the games take about a month. Well, this one's taken a month. The first game took like a week because I'm really bad at chess. But watching the nonverbal communication and skill set you shared with your partner playing chess in our crazy game that we set up was a lot of fun.
Well, it was a lot of fun. I would do that again anytime. I actually told my dad about it. He was like, "We should do that with like me and my brother-in-law, so it might become a family event as well."
I'm all about starting traditions. That's what I aim for. But it's I think the takeaway from that was the ability to communicate non-verbally, right? And to kind of try to pick up what your partner was putting down. And that's one of the things that we like to focus on. I think you do a really good job of focusing on when you talk to advisors, when you talk to clients. It's helping separate the signal from the noise. So we want to get into that today. There's a lot of noise out there. We want to kind of suss through it and curate it and make sure people are paying attention to the right thing. And then also kind of help them understand the psychology behind what they pay attention to and why. Does it sound like a good plan?
Yeah, absolutely. Yeah, we can start a lot to dig in there.
Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth, from financial growth to career growth, personal development to societal progress. We explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers. It's about understanding the world and our place in it. Awesome. So let's start with a little bit about your background, Seth. How did you get to where you are today, and what are you doing with your days?
Well, I graduated, as a lot of us did, in the mid-2000s with a lot of student debt. So my thought process was, where can I go that I can make a lot of money quickly? At the time was important to me. Obviously, that gets less important as you age. But at the time, it was, what can I do to make sure I don't default? And, laid out the options and found financial services and in particular investments, the investments industry, to be an area where you can, in theory, make a lot of money pretty quickly. And I always thought that I wanted to be in some kind of investment oriented role. It was always fascinating to me. Even in high school, I was in some investing clubs and liked, picking stocks with the couple of dollars I had. But graduated, started working where I am today at Columbia Threadneedle Investments nearly 20 years ago. And I haven't left. I started in a sales role. I did that for about 10 years, really enjoyed it, learned a lot, obviously. Then I thought to myself, I want to try to see what else is out there in our industry. So I moved on to a more pure investment role as a portfolio manager and a market strategist. And I did that for about 7 years. And now I find myself where I am today, leading what we call our thought leadership function or advisor engagement group, which is all about education. So I've kind of had a tour through the industry through the lens of my own company, and just really, really love what I do today.
So, Seth, on that regard, because I was asking Wheeler about this, a thought leader, do you have like a specific area that you focus on, or is it just macro? Like, what does a thought leader do on a day-to-day basis?
It's a very wide definition, obviously, depending on which lens you want to take. Certainly, you can have thought leaders that focus on particular areas, a U.S. strategist, international, fixed income alternatives, whatever it might be. For myself, the way I like to think about it is I face off specifically with financial advisors and their clients, and I try to take the complex, which I guess is kind of what we're talking about here today, take the complex and simplify it in a way that everyone can understand and make use of it in their day-to-day, namely through their investment portfolio. So no, I don't have one particular area of focus. I try to look out over the next year, 2 years, 3 years, see what are the trends out there, what's going on in our industry. It could be market related, could be regulatory, could be financial planning, and try to take whatever that complicated topic is and distill it down again in a way that's practical, tactical, actionable, whatever adjective you want to throw on it.
So when you're kind of putting together your thoughts, right? As a thought leader, that's your place, is like to get out there, share your thoughts. What do you digest first? Like, what is your information diet? What are you like reading through, hearing, listening to, talking to people about? Like, what are your sources that you go to that you can trust and rely on? And then how do you kind of filter out all of that information?
In today's day and age, as I'm sure you guys can appreciate, it's getting harder and harder to do that, right? The diet of information that we're fed is more varied than ever. I generally start within my own company. I trust our research. I trust what we do. We are non-biased, non-political, obviously. We are focused solely on driving the best outcomes for our clients and for investors. So I like to start there. We've got a lot of people that work on very niche areas, and it's their sole job to figure out what exactly is happening with emerging market stocks in Southeast Asia or whatever you want to call it, right? It's their job to make sure that they're producing the best performance in that area. So I tend to start internally. We have analysts, we have portfolio managers, we have strategists. I try to distill what they're seeing in their particular areas into one coherent message for our clients. But of course, I look externally as well. Obviously, who doesn't? So whether it's the Wall Street Journal or Bloomberg, a lot of government websites, government data. Obviously, I look at what the Fed is saying. They have brilliant economists there. And of course, I look at a lot of our competitors, right? We're in a very competitive industry. There's a lot of really, really great asset managers out there. We're all trying to do the same thing. We're all trying to produce the best results for our clients. So it would be remiss of me to say that I don't look at what our competitors are talking about as well. Then again, try to take all of this and distill it down into one coherent message that we can share with our clients, and that hopefully they can share successfully with their clients.
So I guess in that regard, Seth, just kind of diving in here a little bit, it seems like there are always topics of conversation that we're constantly going over and chatting about with our clients, especially nowadays. And I feel like from like a macro perspective, the big three are just kind of interest rates, inflation, and then just economic growth in general right now. So I guess what's your take on those three, and what are you communicating to most people in this day and age?
Yeah, going back to what you were, Cass, were just saying about the noise and where you're finding your information, I think it's really easy to go astray on any of these areas. But I would say that, by and large, we're in a pretty good place economically. Interest rates, they're up a little bit, but not dramatically. And inflation, where we've been talking about this shock, obviously, to inflation right now with the war going on and what's happening in oil markets. But even still, that is very subdued. Obviously, there's some dramatic changes coming to the inflation picture as well. So again, depending on where you get your news from and how you digest it, you can come up with a lot of different narratives. But let's take them a little bit deeper one by one. So first, economic growth. We'll stick to this country, namely. We can talk internationally, if we want, but I think most people are interested in what's happening here in the US. So big picture, we're in a pretty darn good place. And we have been for quite some time, right? Really coming out of the COVID shock, we've been in an environment of pretty strong economic growth, especially if you consider where we had been pre-COVID or over the last 20, 25 years. When you think about economic cycles, as the definition of a cycle, things kind of go up and down, obviously, right? Cycles have tended to last in this country, call it 6 or 7 years. Go back over the last 25 years or so, we've been in an environment where economic growth goes up, then we hit a recession or a soft patch, and that cycle ends, and then it goes back up again. But over the last 3 or 4 cycles, every time we've come back up or come out of a trough or out of a recession, that growth path has been lower than the one before, right? We've kind of, the slope of that growth has slowed. That's been true in every recovery we've had over the past 3 or 4 cycles, with the exception of this one. So coming out of COVID, we've actually seen very strong growth, almost double what we were the last economic cycle, which was coming out of the global financial crisis, and that obviously ended during COVID. So it's hard to say that the economy has been slow or anything like that when the numbers are pointing to quite the opposite. And we see that continuing. Of course, we're not going to see the same kind of economic growth we saw a few years ago, which was anywhere from 4 to 5%, depending on which year. But we still think it's going to be pretty robust. The main reason for that is going to be the productivity boom that we're all living in or feeling right now, or expecting to continue because of AI. We can certainly talk about that deeper later on if you guys want. Quickly on inflation and interest rates, Obviously, those two are tied very closely together. I think a lot of people actually don't appreciate how closely they are tied. They tend to think that they function a little bit independently. It's actually the same subject if you think about it, right? Interest rates are generally a function directly of what's happening in inflation, right? Higher inflation leads to higher interest rates, lower inflation leads to lower interest rates. So the first one we have to talk about there is inflation. What's going on? Obviously, we've come through a period of incredibly high inflation, right? 8-9% if we go back, 4 or 5 years ago, coming out of COVID, to where we are right now, call it 2.5 to 3%, depending on which measure of inflation you're using. Let's say we're at about 2.5 to 3% right now. We know that that is higher than where the Fed wants us to be, right? They target 2% inflation. We can talk about why they target that in a minute if you guys like, but they target 2%. We're a little bit above that right now. So they want to see that continue to come down, but there's a lot of forces that are preventing inflation from coming back down to that 2%. But nonetheless, you're not in a period of runaway inflation again, right? There's been a lot of talk lately that this oil shock, has gone up to $120, $125 a barrel. But there was a lot of talk about how that's going to lead to another inflation shock. We are just not seeing that. And if that's the case, where interest rates are right now, we think they're at kind of a peak of where they're going to be near term and should start to trend down again from there. And again, we can talk about when we say interest rates, what are we talking about? The Fed funds rate, that's one thing. We're talking about the 10-year treasury or even the interest rates that we all invest in. But generally speaking, we think interest rates will continue to trickle down over the coming years.
So interest rates, inflation, economic growth, those are, I think, materially important to us year in, year out. It feels like more so since COVID, right? I think that when you dig into what created the inflation, what can contribute to the inflation, we look at monetary supply, et cetera, to simplify it, right? The narrative of we helicopter cash to everybody, people have more cash to spend, and then that drives up the prices of things is kind of easy for somebody to kind of latch onto that. That can kind of explain inflation. And then you can have other geopolitical forces that might explain inflation. But it's really just money being spent, right? And it feels like we've been in a place, and you can obviously correct me if I'm wrong here, but I feel like in general, we went from an industrial economy, like an economy that really created and sold goods, to an economy that really consumed goods. And then turn of the decade, maybe turn of the century, but especially turn of the decade, we really kind of like crank that up. And we talk about productivity, and that's important, but spending just increases and increases and increases. And it doesn't seem like it, to your point, is increasing in a way that we're outpacing our economic growth or our productivity. We're kind of, you're seeing maybe some increase in like credit card debt, for example, some little things along the margin. But there's still exorbitant excess cash balances, in money markets, for example, or savings or checking or CDs, whatever, like cash on the sidelines, as they say, not being spent, not being invested. And maybe that's, you could complicate this and say, maybe that's a factor of wealth disparity, and the haves have a lot and the have-nots don't, and then you can get into the K-shaped economy, et cetera. But I feel like, just to really dumb it down, if interest rates and inflation are really tied together, and we try to control inflation by controlling the interest rates, when does that not work, right? Like, when does that work? When has that worked in the past? And when does it not work?
Yep. I like your definition on inflation. It matches what I tend to say, which is essentially you have too many dollars chasing too few goods and services, which is where we've come from, obviously, over the past few years, right? People, and to the point you're making, flush with cash, particularly coming out of COVID, because we weren't spending on travel and eating out and things like that. We had a lot of dollars, and we were chasing, a supply constrained set of goods and services. And that's what led to the inflation picture that we had. To your question specifically about when does that relationship not, well, actually, before we get into when does that not work, let's talk about that relationship a little bit more for a second. And I always like to start with, why do we invest to begin with, right? What is kind of the underlying purpose of investing? If you break it down to its simplest form, you could argue that it's really to beat inflation. or maybe a little more, academic, it's to preserve your purchasing power. What do I mean by that? $100 today is worth a lot less than $100 in a year, given some level of inflation, right? It'd be hard to picture that year to year, but we can think back to 10, 15, 20 years ago when a gallon of milk was $2 or a carton of eggs was $3 or whatever you want to call it, right? And now obviously things cost more. So again, why do we invest? We invest to make sure that our money at least keeps up with the rate of inflation, so we don't lose purchasing power. Our $100 today buys as much as that $100 tomorrow. And of course, we want to earn what we would call a premium above inflation for investing, or a little bit of a margin on top. So if inflation is running at 3%, we want to earn at least 4 or 5 or 6% in different types of asset classes. Bonds, stocks, alternatives give you a different level of premium or margin above inflation. So let's talk about kind of the easiest one to picture, and that's bonds, right? Because we talk about interest rates, and when we talk interest rates, we're usually thinking about bond investments. So if you look at that historical relationship over time, inflation to what bonds get you, it's about 1 to 1.5% above inflation. So if inflation is running at 3%, you should expect your bond investments, your interest rates, to get you 4 to 4.5% over time, right? You're preserving your purchasing power and getting a little bit of a cherry on top. So that's kind of the idea of why we invest and what that relationship is. Now, Wheeler, to your point about when does that relationship break down, it's almost always due to some either extreme levels of stress in the market or extreme levels of exuberance, right? So let's talk about that. In an extreme level of stress environment, people are buying things like bonds, specifically US treasuries, right? That's what's known as the safe haven asset of the world, right? When things go bad, everyone buys US treasuries. What does that do? It drives the price of those bonds higher, which means it drives the yield or the interest rate you're getting on those bonds lower. So that relationship starts to break down. Now, of course, the opposite could be true, right? During times of extreme exuberance, where people are selling a lot of their bonds to buy things like stocks or cryptocurrencies or whatever it might be, and the inverse of that happens. And I would argue that right now we're in a little bit of this environment where we have this kind of fear in the markets. Where we are right now, stocks are down 5, 6, 7%. And what's the beneficiary of that? It's bonds, and to your point, a little bit of cash, right? We're seeing people pulling money out of the stock market to put it into cash because we're at kind of that fear part of the cycle.
So, Seth, in that regard, and Wheeler, I know kind of tapped into this a little bit, but I'm constantly having conversations with clients. And, when it comes to the economics, I think you framed it well, where what growth is basically too many dollars chasing too few goods. But it feels like to me, given that 54% of Americans don't even have a retirement account at this point, and most of the people we talk to feel like while inflation has gone up, wage inflation hasn't really gone anywhere. And now there's this huge fear of AI taking over people's jobs. I know in theory the economy is looking good, but it feels like to me, whenever we speak to an actual consumer or a client, there's like a disconnect there where people don't feel like things are going.
So, so it's funny you say that. I would argue there's a little bit of kind of behavioral bias, or what we would call recency bias, playing in there, because I would disagree a little bit with something that you just said. You're right that wages have not kept up over the last couple of years. So people might be feeling a little bit of that impact right now. But if you go back over this full cycle, let's call it, right, go back to the COVID period, wages have actually beaten inflation over this time period. So we look at what's called real wage growth, right? And whenever you throw the word real in front of something, we're talking economics, it just means inflation adjusted, right? If you got a raise of 5%, but inflation's up 5%, your real wage growth is actually zero. You didn't make out at all, right? Because you just kept pace with inflation. But if you go back over the last 5 or 6 years through this kind of post-COVID period, real wages, or wages adjusted for inflation, have actually gone positive or exceeded inflation over that time. So people are better off, at least in mass, on average, in theory, people are better off than they were 5 or 6 years ago. but we just don't feel it. And again, why is that? We think it again, it comes back to kind of these behavioral tendencies, right? We remember the good old days when, again, a gallon of milk was only $3 or whatever it might be, and we long for those days. But we forget that I actually went from making $20 an hour to $25 an hour or whatever it might be. We kind of forget about that component of it. So there's a little bit of a disconnect there. But to your point, yes, we've been talking about what we call I don't remember who coined this. An economist coined the phrase the Vibesession, a few years ago. And I feel like we are still living through that, right? We are not in a recession. We have not had a recession. The economy is actually pretty good, but people just feel kind of crummy. And the vibe out there is that we have been in a recessionary environment.
Yeah. I mean, it definitely feels that way. Like whenever we talk to a lot of clients, they don't feel great. And it's funny because you look at the market. Yes, I know it's down year to date and whatnot, but overall, economically, all the numbers look good, but just people don't feel good. And I don't know, it's strange.
Yeah, and I think it was Kyla Scanlon, not an economist, but what are we, Zillennials? I don't even know anymore. A young thought leader, Seth, Kyla Scanlon. And I think part of the issue is that you're right that I think we get big fits and starts in wage growth, right? And it's not always just like the market. It doesn't just move in a straight line in terms of like speed of growth and speed, the increase. And what's been difficult for, I think, some people to swallow in this country, I do this a lot. I keep saying company when I want to say country. And it's like, well, how similar are they? They're really similar, honestly, especially these days. But I think real wage growth since the 1970s, when we had that whole stagflation belt, is like 0.5% annualized, like year over year on average. And I think that that's led to a lot of like this disparity that we're navigating right now. And I think AI is like the biggest boogeyman right now that everybody's pointing to. Like, see, this is what's going to make it worse. This is like the nail in the coffin, et cetera. I'm going to read a text to you I got last night from a former friend of ours, actually. And he sent me this text. He said, bro, first of all, but he said, the country is poor. AI is killing jobs. We are at the brink. Just tell the truth. We're all effed. And what I think is interesting about that is, yeah, this is a guy who's in a lot of pain, obviously. Like he's suffering. And so he is putting his suffering out there into the world and saying that's what the world is, right? He's projecting. And I think there are a lot of people who feel this way. So, just like I think any big event, people could look at AI as an opportunity or a risk or both. I think that there are a lot of people who feel like this guy feels. And that's what I think Colin was referring to a degree, not maybe as exaggerated as that. But it's really hard to separate. Like you look at the stock market, like after today, we could be break even on the year again. I think actually, while we were off the highs, we were still coming into our conversation today, basically like flat from January. And right. And then if you look at the return on the S&P 500 over the, especially since COVID, but even a little bit leading up to COVID, the annualized return on it is, I used to laugh at the people who said, like, you should assume a 10% return on your stock portfolio year over year. And I'd say, well, here's my financial advisor hat, and that's not a safe assumption. But we've basically been getting more than that annualized for almost a decade now.
13.49% over the last 20 years annualized.
It's crazy. And that includes COVID. That includes a great recession.
I want to get back, Wheeler, to your point, though, about AI and this text that you read, which I think does encapsulate how a lot of people are feeling. But again, I want to emphasize this word feeling, and it's not yet playing through in the data, right? I'm a big data guy. I like to point to a lot of numbers. I don't have all the numbers on this off the top of my head, but generally speaking, the data is not showing at the moment that AI is coming for anyone's job, at least not in mass. Of course, there have been some companies that have announced some layoffs and they've pointed to AI, but you have to wonder, is that just a CEO saying we're doing this, we're investing in AI because they're trying to prop up their stock price or juice returns and get people interested in their company? In mass, for the economy as a whole, we are not seeing AI have any meaningful impact on the broader labor market. Now, to your point, from whether you think about it from an opportunity or a risk perspective, yes, if you are in either an unskilled job that AI can potentially take over, maybe customer service, or maybe even a highly skilled job that AI can take over, like a software engineer. There could be some areas where you are concerned, but again, overall, we are not seeing that yet. What I would argue, though, is that if you are one of these people of the mindset that I'm not going to adopt AI in my life or in my work, I'm not going to take the time to reskill or retool or learn some of these skills, then there is a good chance that you will get overtaken over time. We think that for people that find a way to reskill using AI, find a way to adapt to the environment, there's more opportunity than risk for the average worker for sure.
So, Seth, in that regard, just thinking through AI because it's a conversation that comes up now basically every day on every podcast for
Every
the most part.
podcast.
Yeah, pretty much every podcast, not even our own, but all the other ones as well. Like putting your crystal ball on, some people say that there's never been a massive change of technology that hasn't created more jobs than it's replaced. Other people are saying that there's going to be mass layoffs, and like what you just said, if it's potentially unskilled or potentially skilled, but you're not using the AI, it might displace you. Like, what do you think about the next few years in general, just with AI coming into the picture? Because we're already starting to see, like, Oracle just announced a ton of layoffs. We're starting to see companies, in particular in the tech field, doing a lot of layoffs. Is that because they were overstaffed or is it because of AI?
Yeah, I think you would argue it's the idea of overstaffing or how much they built up. If you looked at hiring of software engineers coming into 2021, 2022, it was like a parabolic curve. So there was over hiring as firms built up to this AI arms race, and they were offering obviously massive compensation packages. I think you're just seeing some of that unwind right now. You could even argue that these people are victims of their own success, right? If you look at the quarter that Chat GPT launched, right, in Q4 of 2022, there was actually a little bit of an inflection point there where there was this massive hiring, massive pay raises, et cetera. And then as soon as it launched, it was like, oh well, AI is no longer up and coming; it's now here, and that was the inflection point. But I want to get to just really quick big picture, because I think a lot of times when we get into these conversations, we kind of focus on individual sectors, individual workers. Makes sense, right? It's all personal to us. But let's look at the big picture for a minute and think about how does productivity, because that's what we're talking about here, how does productivity affect the big macroeconomic picture? And then we can talk about how it kind of trickles through the economy from there. I like to, as Wheeler knows, I like food. I like to compare a lot of things to food. So I'll give you my food example here, right? Imagine that you owned a bakery and you wanted to bake more bread. I would argue there's only two ways to bake more bread. You can either hire more bakers or you can invest in better ovens, better mixers, etc. In this example, the US economy is just like the bakery. So, Wheeler, maybe your country, company, mix up is actually working
See,
for us.
it happens, man. It
It all
naturally
comes full
fits.
circle. Yep. So the US economy, right? You either have to hire more bakers, which is population growth or labor force growth, or you can invest in better ovens and better mixers, which is productivity growth. Now we know at the moment that the population or labor growth side of that equation is stagnating dramatically, right? Not only are we not having babies, right? We're not procreating, we're also cutting off immigration in dramatic form, right? So when we think about those two inputs to economic growth overall, it's a very simple equation. You just add the two together, growth in the labor force and growth in productivity. Say you have 2% growth in your labor force, 2% growth in productivity, your GDP growth is basically 4%. It's almost as simple as that. Of course, there's a few other variables here and there, but economists will often point to these two things as the major drivers of an economy. So again, right now, our bakers, our labor force growth is stagnating, but there's a lot of excitement on the productivity side in what that can do to drive the economy higher. And if you think about it, with population growth only expected to be about 0.3, 0.4% over the next decade, we're going to need productivity growth to drive the lion's share of economic growth for the betterment of all of us. And lucky for us, most economists think that that is going to be somewhere in the vicinity of 2 to 2.5% productivity growth for this country over the next 10 years, which will rival some of the booms that you've talked about, right? Either, turn of the century with, technology and the internet, et cetera, can even go back, 100 plus years ago to railroads when they started, traversing the country. That is the kind of capex and economic boom that we're talking about from a productivity perspective.
I think what's interesting is that almost no companies are just bakeries, right? Anymore. Like Starbucks, for example. Starbucks was just like espresso and drip coffee, right? And then they became like a Frappuccino company, right? And then they became food and they became whatever. Their drip coffee
And now they're
is
now they're a tech company, you can argue.
yeah, now they're a tech company.
With all
Everybody's a
the
tech
mobile
company now.
ordering on the app, everything. Yeah, their
Right. Yeah.
fortune is
Yeah.
tied to how successful their app has been.
Yeah. But these businesses, they grow and shift over time, right? Like I think the perfect example or the best representation of overspending is probably Meta, right? And the reason they're called Meta is because they were vastly overspending on the metaverse that we've all forgotten about. That was like a nightmare, like a really bad dream that we've all moved on from. But they're Facebook, their Instagram, and their AI, right? And their advertising, they're all the different things, right? And I think they need different skill sets for those various areas of the business. And then some businesses become, or lines of the business become more important than others. So just because we see layoffs, that's maybe a better representation of what's going on with that specific business. And maybe there's some sort of trend influence on it, and less so a representation of a larger trend. It's like we're looking at it inverse. We say, see, everybody's losing jobs, when it's really like, well, that company's riding the ship or what.
Yeah, I mean, let's talk about Microsoft as a perfect example of that right now, right?
Right.
Microsoft, the stock is sold off, as almost all software companies have lately, in dramatic fashion. We would argue it's a little bit overdone. But why? Like, what is the fear for Microsoft? It's been one of the most successful companies of the last 50 plus years. Right now, the kind of narrative is that their per seat revenue model, which is basically the licenses, right, that we all have. If you work for a corporation, you have a Microsoft license for, Outlook, Excel, PowerPoint, etc. The narrative is, well, hey, if AI can do a lot of these things, then why does every employee at your company need a Microsoft license, right? So that model is under pressure. Then if you take a step back and you think about it, you say, well, if we all are using more AI, how do most corporations, at least big corporations, use AI at the moment? It's through Copilot, right? It's not Anthropic, it's not OpenAI's ChatGPT, it's through Copilot, which is completely embedded in the Microsoft system. So if you want to use AI at a big corporation, you still need that Microsoft license. And by the way, as Copilot's capabilities improve, they could actually start to charge more for that, more than an equivalent Excel or PowerPoint license, right? So again, we have, and maybe this is getting to the kind of behavioral side of this conversation, these fears, these emotions all of a sudden, oh my God, AI is going to put Microsoft out of business. No, of course it's not. Might it change how Microsoft does business a little bit? Sure, absolutely. But you have one of the most blue chip, one of the most well-run companies in the world. They are priced right now as if they're going out of business. And I can assure you, they are certainly not.
We yesterday did an exercise as a team where we were just going through our client list, checking off kind of people and figuring out tasks and all that stuff. And we were doing that with our CRM system that we use. And the entire time, I was just sitting there thinking to myself, if this could be in Claude or ChatGPT, obviously it can't for compliance purposes and things like that. We have to make sure our clients' data is protected. But if it could be that way where we could just tell Copilot or whatever the AI thing is that you're using, hey, who are the clients that have required minimum distributions coming up this year? And where do they live? And, when's the last meeting we have booked with them? And is there anyone that's not booked yet that we have to talk to about this year? Like those types of conversations would save us and our staff hours and hours of work. And that doesn't mean that we wouldn't do the job and there wouldn't be work anymore. It just means that it would get done more efficiently. And to be honest, I'm super keen for that to happen because moving between systems and having to juggle between different things, like there's such an opportunity for data consolidation that I agree with you. I don't think it's going to lay off people. I just think people will become more efficient, which is a good thing when we don't have population growth.
Yeah, that's kind of been my argument for Salesforce and all these CRMs, et cetera. Like all these companies have a head start, right? They've got contracts in place, and if they can develop the AI, even Apple, right? Like if, all of these things that we're used to, if they can develop their AI fast enough, then we'll just stick with them because we're creatures of habit.
Yeah, to the point you're making, Colin, you're not talking about laying off any of your staff. You're talking about how can you make yourselves and your staff more productive with AI, right? And you guys are already highly productive as a country, as an economy. We are already highly productive. We have one of the highest outputs per worker in the entire world. I mean, I think most developed nations that are our peers, Germany, Japan, et cetera, we have very high output per worker. We've been enjoying over the better part of the last 30, 40 years, very high levels of productivity to get to a point where it is hard to get more productive than where we are right now. Think about the rest of the world. Think about, Cambodia. Think about Kenya. How do you make a worker more productive in Cambodia or in Kenya? You put light bulbs in a factory so they can work overnight or have a third shift, right? You have very low hanging fruit to drive higher productivity growth in those countries. Here in the US, how do you drive more productivity, right? You need something like this massive spending on AI to build what you're talking about, right? A system that can talk to each other and help engage all of these different functions inside of a company. So it's hard to drive higher productivity. That's why we've been in a productivity lull in this country. But this boom that we're talking about right now is what can get us over that next hump.
Yeah. I think that's a good opportunity for us to kind of shift into the second half of this story is, how do you take this information and process it, and what are like the psychological behaviors at play here? Colin and I had a conversation yesterday about private credit because I've been going down not a Colin style rabbit hole, but I've been exploring some potential risks. I think that when I came into the office yesterday, Colin, I said, listen, I don't want to be Pollyannish, right? I want to just like slow down and let's pause and let's assess this, because we have to not overreact. We have to be able to take the time, and we have more skills, more tools at our disposal now than ever to really analyze a situation. And I think as a society in general, like if we would just slow down a little bit, this is what I've learned in therapy, by the way, and I'm practicing with Jess right now. Let's just slow down. I'm not going to have a big reaction to anything right now. But I think if we can apply that to all the different areas of our life, that'd be really useful. And that's a psychological tool. That's a behavioral tool that we can bring into this. And that's a big area of focus for you, Seth. So I'm kind of excited to get into what's working for us and against us right now.
Yeah, so much is working against us, unfortunately, when it comes to this conversation. You touched on emotions in your comments there, the speed of news, essentially all of that is overwhelming our brains. And that's what has made this topic that I'm passionate about, we call it behavioral finance or investor psychology, such a popular topic in our industry over the last few years, right? It's really the science of trying to understand what are the decision-making drivers that we go through when we have to make an emotional decision. And by the way, all money decisions are emotional decisions. We used to say in the behavioral finance field years ago that the purpose of this study or this science was to try to take the emotion out of the investment decision, right? What we've found over the past few years is that is not possible. There are no non-emotional money decisions. We have to learn to work with our emotions, understand what is driving us towards a certain decision, a certain outcome, why it's driving us that way, and then what we can understand about ourselves to make sure that we make better money decisions, taking into account where those emotions are driving us.
So I'm gonna go down the rabbit hole, Wheeler. I'm gonna take us there. So Wheeler and I, as Wheeler mentioned yesterday, we're chatting deeply about private credit in general, and it's been all over the news lately. There's been major headlines about it in regards to companies going down in value and issues there, but also on the flip side about it becoming more available in things like Ks is a perfect example. And it's now easier than ever to access private credit investments. As we were diving into this, it became, I don't want to say 2000 in regards to what we were figuring out, just in terms of the amount of leverage, the pricing, the fact that there's no ratings on any of these underlying loans and things like that. Like it became scary kind of quick, almost like Big Short like. And I just kind of wanted to get your take on this because it's becoming a huge part of the investor landscape. And then private equity now is bigger than ever as well. Like, what's your take on private credit? Like, is this a legit risk?
Yeah. Yeah, we've done a lot of work on private credit over the past couple of years, as you might imagine. Let's take a quick step back for a minute. Let's talk about kind of how we've gotten to where we are right now in private credit, right? Let's go back about, say, 10 years, right? We were in what, economists called ZIRP back then, you guys might remember, right? Zero interest rate policy. This was kind of in the pre-COVID and actually through COVID period where interest rates were exceptionally low, right? We're talking 1, 2, maybe 3%. So in that environment, when you have all of these big institutional investors, things like pension plans, university endowments, corporate balance sheets, they were used to investing in the bond market and getting 5, 6, 7% returns. And institutional investors like that are dramatically bond investors over, say, stock investors, right? They have this slightly more conservative mindset. They have obligations they have to meet, etc. So in that environment, private credit got really, really popular with those types of investors because interest rates in general were low. Private credit was getting you 3, 4, or 5% interest rates above where you were in the traditional or public bond markets because of what was called, or what is called, an illiquidity premium, right? That's simply to say, if you are willing to lock your money up for a longer period of time and you don't need to have access to it, any day you want, and you don't necessarily need to know what's going on with your money behind the scenes, you would expect to get a premium or higher return for that, hence the illiquidity premium. So again, 3, 4, 5% above what you'd be able to get in the public markets. Fast forward to maybe the last 5 years or so, because of technology, because of the democratization that you're talking about, these types of investments have become available to retail investors, not just these institutional big players. Where has that led us? That's led us to an environment where, if we want to pull in a behavioral trait here, herding bias, it's led us to this place that, oh, everyone's doing it, I should be doing it too. Think about like cryptocurrency or Bitcoin years ago. Everyone's investing in it, I want to get in as well. Private credit became that big thing that, was hot. Again, people were looking at bond market returns, say in 2022, which were negative and dramatically negative. There was a lot of pain in the bond market. This is where else can we go to get these bond-like returns? In comes private credit, now available to everybody. So asset management companies, like my own, like many, they're not going to turn dollars away. So people wanted to invest in this asset class, but at the same time, there weren't enough opportunities out there to meet the inflow of assets. So what did these companies have to do? They had to use a little more leverage than maybe they expected to, and they had to invest in more exotic things, right? So private credit, why do private credit exists to, help a company finance a factory, maybe an AI data center, maybe buy a new fleet of airplanes, right? That's kind of the private part of that market. But companies flush with this incoming cash had to find even more exotic things to invest in. And then you fast forward to where we are today, or over the past few months, where people have started to get a little bit nervous about the markets. Obviously, they've wanted to pull their money out, and in comes that illiquidity premium where the companies said, well, it's not that easy to pull money out because we just financed, a bunch of Gulf streams, and we can't just turn around and sell them to raise money to, give back to our investors who want their money. And that's where we're getting into all the problems that we're getting into today. So how does it relate to, some of this behavioral stuff that we're talking about? So herding, I mentioned already, absolutely. The idea that other people are doing it, I want to do it too. But I think there's also what we call representative bias here, where people take what they have in front of them, kind of the knowledge or whatever they can find, and automatically extrapolate an outcome from that, right? So we compare private equity to private credit. Private equity over the past 15 or so years done pretty well, right? And you could argue in some cases maybe done better than public equity. People automatically will say anything that's private has to be better, right? If private equity did better than public equity, private credit has to be better than public credit. Not necessarily always the case with all of these different market variables. You can't just take what information you have in front of you and turn it into a forecast for the future.
Yeah. So you just went through like a ton of behavioral factors here, right? And you call it herding, I call it FOMO, but you sound smarter, so we'll go with herding. But
Same thing.
you just went through overconfidence. You went through recency bias. You went through representativeness, right? You went through all of these things that come into play in the choices as an investor. And on the other side of this, I think there's also elements of greed, right? Which doesn't have I'm not using a fun behavioral economic term there. I'm just people want and want and want, right? And then look, you brought up 2022. That was a tough time for Colin and I as advisors because we lacked diversification in our models. We thought we had them. We thought we had that lack of correlation between bonds and stocks, but in the end, we didn't really, right? And private credit at least had the illusion of diversification. They maintained value, and then what we call statement risk came into play. This account looks great, didn't lose value. What's going on with that? Why can't we have more of that? And I think one of the things that we were going through with private credit here yesterday, Colin and I, was talking about the democratization of it all, right? Making this more and more accessible so more and more dollars can come into that space. So more and more money, I think, can be made. And you pointed out, nobody's going to turn those dollars away and say, no, we can't do that. They're going to say, let's try to find a solution. And it might start off in a very well-intentioned way. But I think there's a lack of communication that comes into play as well, because advisors aren't explaining the gates, right? They're not explaining how illiquid this is. They'll say there's an illiquid premium or liquidity premium, and then they won't really make sure the client understands that. And I think that's an issue in general when it comes to investing, making sure the client understands the risks that they're taking, the perceived risks, the unseen risks. And I think that in general, when it comes to investing, you brought up earlier, the primary reason is to keep up with inflation. That's the main goal, right? And then it's maybe to improve your lifestyle a little bit, right? Or to have enough money for retirement, to do all these different things. But in general, just want to keep up with inflation. I think when it becomes more and more and more, we want the Bitcoin Lambos, we want to have money and never lose value, et cetera. It creates larger issues. And that all comes back to the psychology of the investor and, in some cases, the advisor.
Yeah, I can't believe we've gotten through this much of the conversation as we have without me pulling out a philosopher quote from the 15 or 1600s. So I think here is actually a pretty apt moment to do so. To one of the points you just made, Wheeler, I'm going to go back to Adam Smith, who in the 16 and 1700s wrote extensively about human nature and markets. Obviously, the stock market was very different back then than it is today. But Adam Smith, he wrote a book called Theory of Moral Sentiments. Maybe some people know him for Wealth of Nations. One of his most famous quotes was, if you don't know who you are, the stock market is a very expensive place to find out. I think there's a lot of prescient insight to that quote, to what you're talking about right now in private credit. Obviously, private credit existed back then in a very different form. It probably was people just making random loans to somebody, and then they would kill them if they didn't pay them back or whatever. Private credit is not new. It's existed forever. It's basically just somebody or something making a loan for some purpose, but not a bank, right? That's essentially what private credit is. So again, if you don't know who you are, the stock market, or maybe in this case, the private credit market, is a very expensive place to find out. And that's what we're talking about here, right? Is understand, not to say that risks are bad. Risk is actually very good, right? Of course, in investing, with more risk, generally over time comes more return. But you can only appreciate or experience that higher level of return if you have the stomach to appreciate those risks and ride it out for the long haul. And that's what a lot of people don't quite understand, is what types of risks come with seeking more return. Could be small cap stocks, could be private equity, could be alternatives, could be oil, could be Bitcoin. It's a story as old as time. You have to understand the risk you're taking to be able to reap that reward or that benefit.
Yeah, I guess there's always going to be some hot new investment or a product, whether it's, like you said, Bitcoin or private credit or whatever it might be. I think the thing that sticks out to me, though, the most with this is the fact that it becoming more available in publicly traded investments and, 401ks and things like that. To your point, we know what people do when the market goes down. People panic and they sell. Like, it's just human nature and it's super predictable. So if people are going in and they can now sell these things more freely than they could before, then that is going to cause more pressure on these private credit companies, like unless I'm missing something.
No, you're exactly right. It's the cycle that we all tend to go through throughout either an economic cycle or a market cycle. We actually like to call it the investor psychology cycle, right? And it's happening maybe right now in real time as well. And you could even argue over the past few years, Wheeler, you talked about, greed. If you think about that cycle, you kind of, it starts with caution, right? The markets are starting to do well. People are cautiously optimistic. As the market continues to go up, you get into this kind of confident period. People are like, well, maybe, the market's been going up for a while now. Maybe I should start to invest more. When you get to near kind of the top of that cycle, people are experiencing things like greed. They're experiencing conviction. Another quote that we all know, this one from Warren Buffett: you want to be fearful when others are greedy and greedy when others are fearful. You could argue that where we were, a couple of months ago at the beginning of 2026, we were in this period where people were kind of greedy, right? They had full conviction in the market. The market had been doing phenomenally well, as you guys pointed out, right? 13+% returns for almost 10 years in a row. Then, things started to get a little bit choppy. The market started to roll over. I would argue where we are right now is maybe a little bit in this fear, right? We haven't gone into panic. We're certainly not in contempt, which would be the other side of that cycle. But right now, there's a little bit of fear being introduced. And I would argue, as it relates to at least the psychology cycle, that's not necessarily a bad thing right now to temper people's maybe worst impulses when the market was at its peak.
Yeah, it's a really good point. I mean, we were starting to get to that place where I was receiving the client calls about, silver. Let's get some silver. Let's get some former Bitcoin miners that are now energy companies. Let's get this, let's get that. Let's pay, 50 times earnings for Costco. I think what I'm curious about right now, because I see some of that fear in the market, but perhaps what I'm seeing is maybe just more FOMO in a different way. Maybe, we're dealing with a SaaS apocalypse because we feel like that played out, right? Those software companies, they ran, they did what they were supposed to do. Palantir did whatever it did. And now let's go chase something else like, Caterpillar. I wonder if there's some sort of like Pavlovian condition here where we are seeing maybe retail investors in particular learn that if they just buy the dip, the market will come back up. That seems like it's been the case more often than not for at least the 20s, right? Do you see that? Is that something that you've seen on your side or you've talked about on your side? Do you feel like we are maybe not recognizing the risk as much, and so we're just quicker as a society or as a market right now to buy?
Yeah, that is a great insight and something that we've actually done some work on and looked into. Think about it this way, right? We've had some market cycles over the better part of the last, 10 or 15 years, but we really haven't had a true economic cycle. Right? We haven't had a period of time where we've had this complete washout, this idea that when the tide goes out, you see who's standing there in their underwear, right? We just haven't had that, right? You got to think back to the global financial crisis of '08 and '09 to get a period of time where we've had that washout, where where bad companies went out of business, right? That's what's supposed to happen in a true economic cycle. Yes, COVID officially was an economic cycle because we did enter into a recession, right? It was a very short recession, but technically that was the start of where, talking about what the definition of a cycle, that was a new cycle. But we really didn't get this period of, sustained either market drawdown, crap companies go out of business, the market is rewarding just solid companies. It was too short lived. So to your point, where we've had this buy the dip, you can even argue that the COVID downturn was a buy the dip situation, and we've had that every market downturn of the last 12 or 13 years or so. Do we see a recession like I'm talking about on the horizon? No, we do not. We don't see that anytime in the near future. We don't see this kind of washout event where you have a bunch of, say, these high risk, high flying, non-earning, non-profitable companies go out of business or anything like that. But that's really, I think, what you would need to remind people that, investing is not just something where you keep throwing money at companies and they keep growing forever. It's one that you actually have to decide or separate which are the good companies from which are the bad companies. And the good companies over time thrive and the bad companies over time go away. I think that is what we would need to get to. And we haven't had it. And at least at the moment, we don't see it in any point in the near future.
Well, I feel like that was like a great thing to end on in terms of like client messaging. I feel like that was like the perfect juxtaposition. My one last final closing question for you, Seth, is if you were to go back and talk to yourself when you were just getting going kind of in your career and your investing life, what piece of advice would you give your early self?
Whew, that's a great one. That's a tough one. I would say if anything, it would be to really lean on the power of personal relationships, both in our business, but maybe in life as well. But since you're asking about the business world, I'll focus on that one. We are in a numbers business, but really what it comes down to is this is a people business. And it's not that I didn't do the networking and get to know and all that kind of stuff early on in my career. But if I think back on it now, just keeping certain relationships, right? People come and go out of your life, people come and go out of your company. Obviously, finding a way to keep up with people, finding a way to reach out, pick up that phone, send that text, send the email, stay in touch, use those personal relationships more to your advantage over time. I think that is the greatest strength, probably not only in our business, but most likely in our lives as well.
Great point. And I think as we kind of navigate this new transitionary period with AI, that's really something smart to keep in mind. So good thought, Seth. Good thought. And where can listeners find more Seth Buks? Where are you out there? I've seen you on LinkedIn. Where can they hear more from you?
Yeah, it's namely either LinkedIn, where I'm trying to get better at posting. Much of what we write about, what we talk about from my company's perspective goes on our website, ColumbiaThreadneedle.com. I'm trying to put more of it on LinkedIn because I understand how people actually consume net news nowadays. But at the moment, we have a great blog. We have a newsletter that goes out. You can head to ColumbiaThreadneedle.com and sign up for any of that.
Awesome. And we're going to ask our listeners to like and subscribe on YouTube or wherever they're finding us today, and to send emails and comments and questions to compoundgrowthpodcast@gmail.com. I think I got it. All right, Seth, thank you so much, man. We really appreciate you coming on today.
My pleasure. Thanks for having me.
The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
Compound Growth with Wheeler and Colin. Sponsored by Ko-Fi Advisors. Reach out today. Yay!